According to Paul Tudor Jones, if you think about where we are right now, the Federal Reserve Board is fighting something that it hasn't seen really in almost 4 decades, which is inflation. Inflation is a bit like toothpaste. Once you get it out of the tube, it's hard to get it back in, right? Billionaire hedge fund investor Paul Tudor Jones said investors looking to time the market bottom in stocks should keep a close eye on short-term Treasury yields. Jones has said he expects stocks and bonds will continue to sink as the U.S. economy slides into a recession in the months ahead. But while retail investors book losses on both their stocks and bonds, the explosion of volatility across markets is creating plenty of opportunities for macro traders like Jones, who tend to outperform when markets turn choppy. But the volatility that is great for traders like Jones is generally not great for general investment. Asked how investors should navigate markets during a recession, Jones said he has a playbook that has worked in the past. According to this playbook, Jones expects short-term rates will stop going up and start going down before U.S. stocks finally bottom. Let me repeat that. Jones expects short-term rates will stop going up and start going down before U.S. stocks finally bottom. And based on this theory, Jones said 2-year treasuries are starting to look attractive as yields have risen more than 3.5 percentage points since the start of the year. Ultimately, Jones expects the turning point for treasury yields will be to usher in a massive rally for assets. So watch for the Fed to stop hiking rates and treasuries to start either slowing down or at some point reverse. So today we're going to take a look at one chart, and it's the 2-year Treasury note using MarketWatch or bigcharts.com. And in the upper left here, you can see the symbol is BX colon TM UBM USD 02Y. Now, if you want to look at the 10-year, just use this whole thing here, but put in 10Y, or the 30-year is 30Y. Now, MarketWatch only has the price chart and then 2 oscillators, and so it's going to be relatively brief. But as you can see, we've come from, say, this 0.25% all the way up to 4.25% on the 2-year yield in about a year. And that's a huge, tremendous move. Just looking back in time, from this point here, several years back, it took years to get all the way up here to this point to 3.0. So we have rocketed from 0.25 all the way up again to 4.25 and over 4.25. Today we're sitting at 4.2953. So a huge move in a relatively short period of time, and I'm expecting something to break. So that's why I'm still on the sidelines. But as you can see, that is a tremendous move. Now, we don't have a lot of congestion yet at the top end here, but I expect it relatively soon. Again, hopefully within months, certainly within a couple of quarters. But I may be wrong. So watch our charts and watch this chart here, which is again the 2-year Treasury. Moving down into the oscillators, there's only 3 oscillators here. We have the MAC at this point here. It's showing that we're still heading on the upside. It is slowing down. You can see by the histogram, which just kind of goes a little bit sideways with a little bit of increase, not much. But you see here, the slow line is in red, and then the fast line is in blue. There's still a separation, so there's still time. But moving down here into the slow stochastics, you can see that we definitely are up here near the top of the chart. And when we've gotten near the top of the chart, at least within this time period that goes back to 2006, that's kind of been the topping process. So I think we're near a topping process, but that topping process back here took almost a year before the MAC fast line came through the slow line and then on its way back down again. So there could be more than a couple of quarters, but I'm setting my probability at probably 2 quarters. Again, here you can see the topping process there in the stochastics moving down into the Williams at the very bottom here. Now the Williams back here spent its time all the way up in this upper portion for the good part of about 2 years. Now we've been there less than a year, so we can hang up there longer if need be, if that's what the charts wants to do. But I would say that, look, probabilities are that we're going to start rolling over here within the next, say, several months to 2 quarters or so. So back up here to the price chart and one more look at this. Again, this is a pretty good idea to watch interest rates. Watch the 2-year, watch the 10-year. That's what I normally do. And you can also watch the 30-year. But hopefully we will top in the 2-year, perhaps even start to head down in that yield rate. Again, right now we're at 4.2953. So for today, that's ChewDog Charts. Thank you.